let me start sharing now. Um, Tony, could you give me a thumbs up when you see actually what I'm doing? Okay, perfect. Okay, first of all, great to see everybody here, and thank you very much, Tony, for putting the paper on the program, for inviting us to join. It has been a lot of fun, and I really miss these interactions. And this is joint work with Alan Hu, who's a PC student from Yale School of Management. He's a second year, therefore I don't need to worry about placing him for next couple of years, which is a great thing to have. So many economic decisions, actually decisions in life in general, are made after human interactions. For example, in the finance world, one of the most prevalent type of such interactions is pitches. Corporate executives pitch board for certain corporate decisions. Startups pitch venture investors to seek funding. And it is widely believed that in those personal interactions, not only does the content matter, but also the features in the delivery itself, your facial expressions, your vocal emotions, the choice of your words, and so on and so forth. You've been on the job market and you know what I'm talking about, okay? Even though there are a lot of experimental or lab evidence on how those features might affect people's thinking, it is largely unknown whether and how those features in interactions matter in the field. Are there features that could systematically affect the real world financial decision making? What are the economic and psychological mechanisms behind them? And what are the consequences? In those papers, we try to make some progress on answering some of those questions. As an empiricist, when I look at a complex item, such as human interactions, the first question I ask myself is, well, how can I actually build an empirical framework to even study this object? What should be the data source? What should be the way to process those kind of data? And what are the measurement systems? What we view as the major contribution of the paper is that we're going to propose to use video data as input to measure human interactions in the real world. To preview what we're going to do, we're going to use startup pitches to venture capitalists. And you can think of like much other videos that you can use for those kind of video data processing. For example, presentations, interviews, announcements, press conferences, and so on and so forth. With video as data, we build a machine learning-based framework to project all the videos into what we call the 3V channels of information that are visual, vocal, and verbal, and construct a measurement of system around the system of measurement around all those videos. So now we have the empirical structure to study this question. Our baseline analysis tries to ask a very simple question. That is, what do features matter and what features matter for economic decision making? We use startup pitches as a setting. We are basically startups pitch to the VCs, and then we can see the VCs investment decisions. When we explore the effect of visual, vocal, and verbal features, and one result that jumps to us that is very systematic and robust is that the positivity measures, basically you show positivity, warmth, and passion about your venture in the pitch is associated with a much higher probability that the startup will receive VC financing. This applies to all three dimensions, and particularly visual and vocal. But as economists, I think we try to drive our paper to land on the fundamental economic question, that is why those kind of soft interactive features matter for economic decision making, and what are the consequences. In order to do that, we did even deeper video data analysis by looking at subsamples, different people, and so on and so forth, and also combine an experimental evidence that we use those video in the lab, and we test different alternative channels that those features could matter. And what we find is that first, those kind of positive features that affect your economic decisions are not a signal of better quality, okay? Instead, it's actually amplifying your imperfect social cognition and beliefs, and also people just have a certain taste of different type of personalities, even though we show those kind of personalities do not actually affect your future performance, okay? Overall, you can see what we try to do in this paper is to introduce a new methodology and then try to see how powerful it can be in order to help us understand some questions that is very hard without it, and then try to suggest some economic channels. I'm going to now go into the details of the paper, starting from the methodology and the data. But before going there, I would like to make one note very, very clearly. That is, in many ways, I want you to view this paper as a proof of concept. That is, you can think of our economists can actually really start to exploit the big data techniques, specifically using unstructured techniques to process data, and start to ask questions that we might be interested in. And I really hope that you can think this door is open, and if you have any ideas, we're actually going to start compiling a repository to actually allow everybody actually who are interested in using this to start using this technology, okay? So when we started looking at this question, the first thing we need to do is we actually need a setting where we will be able to observe interactive features. For example, we want to look at the real pitches and then see how people behave. And what we are going to use is a setting of startup pitches. In specific, those are startup pitching for accelerator funding like Y Combinator, Techstars, and so on and so forth in a standardized 1 to 2 minute pitch. Okay, this is a very common type of interaction. You can think of like pitch your research in the elevator and so on and so forth, but it's one directional. I think Mike yesterday actually mentioned this in the Slack channel as well, but this is kind of this is actually by choice because we want to keep the methodology as straightforward as possible, but it can be extended to other settings pretty easily. And if you want to think about how it's related to our world at this moment, you can consider basically me doing now, actually. I am pitching, okay, our research in such a setting, and all the videos as the one that on the left is exactly what you see, okay? So this is exactly the type of data we're going to get. But the question is, why can we get this data? It's because when the startups try to get accelerator funding, they're required to upload their pitch videos, okay? And, but why, but how can we convince the accelerators to actually give us those data? The answer is we actually don't need to, because when they ask you to upload your data, they don't ask you to send the data file, they ask you to upload to YouTube and other video platforms and send them a link. And guess what? If they upload it to it, we can use some keywords to back out all those videos because we sort of know their naming technologies when they upload all those videos. So in specific, this is a YouTube screenshot that we are searching Y Combinator application video. And you can see hundreds of them. And then we can basically scrape them down and then download them as our main video source. And we have 20 plus keywords, and we're going to use 1,139 videos from 5 accelerator programs starting from 2010. A major issue here, which is an empirical one and quite important, is that this number looks a little bit small compared to all the firms that apply, okay? Therefore, we're looking at a subsample of all the firms. Therefore, we are going to need to address the video or sample selection problem. But this is something that we did over the past year using a very clever technology. And I'm going to hold that question for now, okay, and trust our results until that I actually show you why we think that doesn't matter, okay? Now we have all the videos and the startups. We match those videos with firm level information from PitchBook, Crunchbase, Venture Expert, and hand-collected information on the founders from LinkedIn. And after doing this, on the one hand, we know the video. On the other hand, we know their history of being invested, their industry, financial history, CEO turnover, founder education, work experience, and their future development, like growth and success, okay? So this is kind of the data structure. This is a cross-section, and for each firm, for each startup, we know their pitches, and we know a bunch of their information, okay? And then the key part of this panel data is for each firm, we observe their pitch video. How can we deal with them, okay? So we view our primary contribution in this paper is the method of processing video data, and a substantial amount of effort are put into this part, and we try to lay the groundwork, which hopefully you can use, okay, in the future. So because this is kind of the first time that we're going to use video data, so we actually spend a lot of time just trying to describe the property and why it is messy to use, and what kind of caveats we should put in here to let us actually use it cleanly. So let me start by describing what kind of properties video data has and why it is something that we should be interested in. So video data first is very information intensive. In video data are multimodal in terms of like giving you both video, visual, and textual information. And to give you a sense of how information intensive it is, 1 second of high definition video is equivalent to over 2,000 pages of texts and about 7 years of full CompuStat data. Okay, that is only 1 second. Just say, hello, this is 1 second. It's already 7 years of CompuStat. Okay, so, but on the other hand, all those information, not all of those information, in fact, most of them are useless for specific purposes. For example, towards the back, you will see actually a ski resort map that I have on my wall. Those are just useless information that as economists that we don't really care. But it is a high dimensional information making us extracting the signals from this low signal to noise ratio data very, very complicated. Plus, even if we can process it, the way that the information is stored in the video data lacks direct implications and direct interpretations. In CompuStat, if it's R&D, it's R&D. If it's asset, it's asset. But all the information that are stored in the video is in pixels, acoustic features, and so on. How can we even try to interpret them given the way that it's stored? Okay, these are the type of questions that we're going to tackle in our methodology. Our methodology comes in 3 steps. The first step that we're going to do is basically to decompose the videos into 3 different channels. That is what we call the decomposition step. We're going to project the videos into visual, mobile, and the vertical features. And for visual, we're going to think of the video as a stream of pictures, and we're going to sample the stream of pictures at 10 frames per second. That is about 1/10 of a second per frame. If you try to think about how fine this is, I just blink my eyes, and on average, a person spends about 0.25 seconds to actually blink your eye, and actually I already get 3 frames out of it. That is how fine that we can do. We can actually push this to as fine as 36 frames per second if you really want the technology to be that fine. And for vocal, we can extract the video, the audio streams out of this. And for verbal, we can use machine learning-based speech-to-text algorithms to actually have all the words spelled out and time-stamped. Therefore, we can merge to video and audio, as well as adding punctuations and so on. Therefore, it has some real meanings when we do the textual analysis. So this is the first step, okay, which is to decompose a video, okay, into 3 important information channels, okay? Then the next step is what we call the processing step. That is, we have the raw materials of video, audio, video, vocal, and visual, vocal, and verbal. We're going to process them separately, okay? For video, which is the visual thing, here I'm showing you just 2 frames out of a video. We're feeding all those pictures into facial detection, where we basically can focus on your face, and facial emotion algorithms. For example, those kind of algorithms will output like dozens of measures, but just to show you the concept, you can see the one on the left, people are happier. On the one on the right, people are just calmer, okay? Are just calmer. You can improve this by adding gestures and so on and so forth, but because our data, like the raw video, does not robustly provide that, we didn't have gestures here. We're going to mainly focus on facial. And then the second one is vocal, basically the way people talk. And sometimes we see someone is an exciting speaker, right? Sometimes we see someone is a boring speaker. Why do we see that? When we hear that, we know it, but we use machine learning to tell us this. And we also have like dozens of measures out of this, but we're going to hear the examples I'm going to show you is that I'm going to show you a high arousal on the left, basically the exciting speaker, like the one that you're hearing at this moment, okay? And also on the right is a boring speaker, where you can see basically the person's voice does not move, okay? And you literally can see for the first 5 seconds, and then after that, perhaps you would just fall asleep. Okay, this is the type of things that we can do using the machines to read all those sound waves to actually create measures for us. And the third one is the verbal. after extract the full script or using machine learning based speech text algorithms, we will be able to merge all of them into some dictionaries from business and social psychology. Here I'm going to show you an example of a very friendly person. Why is this friendly person? Because this person uses a lot of words like together, help, like, look forward, appreciate, pleasing. And all those words give you a friendly feeling. Does it really matter for startup companies? Maybe not, but I will show you those are the type of things that will make the investors actually invest in them surprisingly, okay? So that's the second step. Just to recap where we are, we started from the video and decomposed them into visual, vocal, and verbal. We put them into units, and then we have the algorithms to create measures for them across different channels. And the last step is to aggregate them into per video, different measures. Basically, each measure we're going to do at a cross-section of video level. That is, this video has this kind of measures on average, okay? What kind of measures we're going to focus on in our paper. You can totally expand this for your future paper that you're going to do. We're not going to say we're going to exhaust all the measures, but we want to show you those different measures that we think are actually pretty systematically robust, that are visual, positive, negative, and beauty. Vocal, positive, negative, arousal, balance, basically how exciting this person is, and verbal, which is we're going to look at your positive and negative words, which is something that we have used a lot in textual analysis in finance economics. We also are going to use warmth and ability, which are two dimensions that social psychology psychologists actually use a lot. Basically, what kind of feelings you're giving people when you're speaking. Okay, so this is kind of the methodology. We boil down to each video. We have a video level measure of all those type of dimensions. So what our baseline analysis is a very, very simple one. Okay, on the left hand side, I'm just going to look at whether whether the company is chosen to be invested by the accelerator after accelerator solves the video. And then on the right hand side, the key things are the three axes, okay, which corresponds to the three lead channels from visual, vocal, and verbal. They are all standardized to mean 0 and standard deviation 1. Therefore, we will be able to interpret the economic magnitude fairly easily. We're going to put in accelerator fixed effect, accounting for the unobserved heterogeneity at the investor level. And we have standard errors clustered at the accelerator year. Therefore, we know that it's the same cohort that we're comparing for this, okay? And what kind of result can we get? This is a very, very simple one from visual. We see positive facial expressions like what I'm doing now, smiling, we are associated with the higher probability of obtaining funding. And if you think about the economic magnitude, a 1 standard deviation change will increase from the baseline 17.6% of the probability that you're going to get invested. And symmetrically, negative facial expressions are associated with a lower probability of obtaining funding. And as all the big data projects that perhaps you have seen, the negative parts actually carry more load because people really dislike the ones that show negativity, okay? And you might be interested in, okay, does this thing correlate with beauty? And what we find is it does not really do that. Beauty matters, but at most as important as the emotion reflected. I read as the good news for myself or people like myself who does not look pretty in general, okay? But for us, we actually can just smile more to compensate for that fact, okay? So then we go to vocal. And what we can find is that positive vocal impressions is associated with a higher probability of obtaining financing, and negative ones are particularly bad, okay? People punish that quite more, okay? And excitement, which is the balance, and arousal, which basically shows your positivity, as well as your energy, matters a lot for investment decisions. And from the baseline, this is about 25%, okay? This is about 25%. And verbal is the same thing. Warm words, like the friendly words that I showed you, attract investment because it make me look like friendly. And the negative words are associated with lower investment probability. Positive words are irrelevant, as in most of the textual analysis. What I find very interesting and show how irrational those investors are is that the competence and ability measures are associated with lower investment probability. Meaning that if a person started their pitch with highlighting how much ability and credential they have, actually investors like it. I mean, if you don't believe it, let me start my pitch by saying, you know what? Hi, I am Song. I come from that small university in New Haven, Connecticut. Okay, we are perhaps rich and so on and so forth. Guess what? Perhaps now your impression on me is already pretty low. This is what happens in the investor as well. If you keep stressing your credentials and so on, that's actually pretty bad for an investor. Okay, I described all those kind of results, okay, separately, but you can see one common theme out of it. That is the positivity measures, basically your happy emotions, warmth, passion, draws investment, and the negativities drives away investment. In fact, okay, this theme is so strong that we can use a factor analysis similar to the first textual analysis paper in Paul Tedlock's 2007 JF. If we actually use this factor analysis, you can see the first factor, okay, loads positively on all the positivity dimensions and negatively on all the negativity dimensions, okay? That just lines perfectly. Means that we actually can use this one factor to capture a very important dimension of the pitches that that correlates with the investment decision. Just to see how powerful it is, here I cut this one measure of pitch factor, okay, into 5 different quintiles, and just to see the raw investment probability that those different beings get. And what you can see at the lowest pitch factor, basically the most negative person, you can see that the investment probability is about only 6%. And if you actually reach to the very end, the right tail is 12.5, which almost doubles, okay? So this is why we say there's a systematic pattern of those kind of investment in responding to the pitch features. Here, I want to talk a little bit about sample selection. That is, well, we worry about the videos being available to us because maybe better videos and invested companies are more likely to be keeping their videos online. If that is the case, then we actually will see our results as a mechanical one because certain type of videos are kept there, the invested ones and the better ones. Then of course, you're going to see a correlation of the two. And our approach is actually we tracked YouTube, okay, for the past year to see the video deleting behaviors of the recent uploaders, okay? And then by looking at how they're making their videos unavailable, we actually will be able to see, will there be a selection problem that is working in favor of us that are driving our result? Because of the time, I'm not going to go into the details, but if you look at this selection table, on the left-hand side being the video being selected out, that is basically disappear on YouTube. And what happens is that the disappearing is quasi-random, okay? Meaning that even though we are only looking at a small sample of videos, perhaps compared to all the firms that ever applied, but they appear to be actually just a random sample, which will actually give us both consistent and unbiased estimator of the thing that we are going to estimate here, okay? So this is the baseline. Then the next question is, well, how do we even interpret this thing? Yes, it's intuitive, but what does it really mean? Could that be the case that the signal and the information about the quality of the startup is buried in the pitches? That is, maybe it matters a lot when I see someone is passionate about the product and when I see someone can actually communicate with the investors. And we have 2 tests that lends very little support to this information story. And the first test that we run, which is we also think the most interesting one, is that positive people, that the one that you're in, got it, Tony. And the positive people, okay, basically the one that you invest, actually underperform conditional on being invested, okay? There are different type of interpretations about it, but the one I like is that because I like working those kind of positive people and so on and so forth, I lowered my bar when making investment, okay? Therefore, they have bad performance down the road, okay? Meaning that I am not getting particularly good quality signal about those entrepreneurs. The way to look at this graph is that the blue bar are how the pitch factors associated with the investment decision. And the orange bar is how that correlates with the future performance, where at this graph we use future employment. And what you can see is that the complete they're completely opposite to each other. Okay, they're completely opposite to each other. What matters for investment actually negatively matters for the performance. Okay, I'm going to skip this, but this graph basically shows that the correlation between quality and quality controls and the pitch factors is very low. They're largely independent, okay? Meaning that the pitches, okay, the quality of your pitch doesn't really carry much of a signal of how good the company is, okay? Another potential explanation is, well, maybe this is just imperfect social cognition. That is, people read signals and have different habit of developing their beliefs, having their expectations, and so on and so forth. And if that is the case, then we should see that the way that we read social interactive features like the pitch features should be different across different subsamples with different social dynamics. And the thing that we're using here is by looking at gender differences. That is, we're going to run analysis in both man and woman samples and see how, when we actually change social dynamics across the presenters, the result would change. I have two main results. Both of them are pretty damning. The first one is, if we look at man-only and woman-only teams, they're largely similar with different intensities, meaning that they have the same direction, but the intensity is very different. The investors judge and punish more based on pitch features from women-only teams. That is, if a woman doesn't show positive features, they're going to have a much lower probability of being invested. Okay, this is consistent with a lot of social psychology research that shows that people view or judge women based on appearance a lot more. Another one that we can look is by looking at mixed gender teams. That is, when a presenter team actually have both men and women in it. And we can construct measures for both. And what we find, okay, is that when a man and a woman present together, only the man's features matter. So subconsciously, the investors are only looking at the features of the man rather than the woman, which is another way to say that there's all this social cognitive habit that we develop that are driving some of our results. We run an experiment. Okay, I have about 1 or 2 minutes left, perhaps, but I want to show what our experiment really does, because we have all those kind of evidence that shows how powerful this technique could be. Okay, but as empirists, we want to fit into a model of how investors make their decisions and how pitch features fit into them. Okay, and what channels that they matter. We're going to test 2 different channels. One is what we call the preference channel. Basically, I like working with those people. And another is a belief channel. That is, okay, I think better pitches is associated with a higher probability of being invested, okay? And we test those into, I'm going to skip the model a little bit, but we allow those pitch features, okay, to both go into your preference or go into your beliefs. And by explicitly soliciting your beliefs after viewing the video, okay? And the punchline, sorry, I did all those with hundreds of Yale MBA students who were in VCPE and entrepreneurial finance classes with the basic training in venture financing. And what we can find, this is the punchline here, the second bullet point, which is the belief channel explains 46%, and the preference channel explains about 54%, meaning that I believe that you are a better firm. That explains why I invest in you, 46% of them. And the fact that I like working with positive people, which could be costly, okay, financially, explains about 54% of our main effect, okay? So to summarize, we asked 2 research economic questions. Do interaction features matter for economic decision-making? Why and what are the implications? In order to answer this question, we introduced a video-based approach with machine learning applied to startup funding setting, which we think is the first attempt to introduce unstructured data approach to video data. Our answers are the following. Yes, people showing more positivity, warmth, and passion attracts more investment. However, this is largely costly social cognitive biases, lowers performance, amplifies the biases against a certain population. And again, we think this is a proof of concept for a lot of you who might be interested in exploring more empirical settings and data for those kind of research. And I would like to thank you for your interest. And thank you, Tony, again, for inviting us.
Great. Thanks, Song.